It's official. Mortgage rates have entered the 8% territory. Here's the headline from an Investopedia article last week. It says 30-year mortgage rates surged again Thursday, pushing the flagship average well into 8% territory. That means if you want to go out and borrow $500,000, $500,000 to buy a home at an 8% mortgage, that $500,000 is going to cost you $3,700 a month. A couple of years ago, you would have only had to pay $2,100 a month borrowing that same $500,000 at a 3% mortgage. You're paying almost twice as much today to borrow the same amount of money because of the higher mortgage rates. Not to mention the fact that if you wanted to go out and buy a $500,000 home 2 years ago, you're not going to be able to buy that home for $500,000 today. You're going to be paying $550,000 at least to buy the $500,000 home a couple of years ago. So not only do you have to borrow more dollars, but you have to pay a higher interest rate to borrow those dollars. And then on top of that, we're also seeing home sales slow even further. The National Association of Realtors recently put out a statement saying that in August, home sales fell again, and month over month between August 2022 and August 2023, home sales have fallen by over 15%. Here's a quick statement by the chief economist at the National Association of Realtors. Mortgage rate changes will have a big impact over the short run in the housing market, while job gains will have a steady positive impact over the long run. So it sounds like the National Association of Realtors is still bullish, meaning having a very positive outlook on the housing market. Although the higher mortgage rates could create some short-term pain or slowdown in the housing market, as long as we continue to see growth in the job market, that will allow people to continue to go out and pay the higher prices for homes. And by higher prices, it doesn't just mean the home price being more expensive, it means the mortgage payment being more expensive. However, you have to pay attention to how fast mortgage rates are increasing, because over the last couple of years, your monthly payment has almost doubled. And most people's incomes have not doubled over the last couple of years. So you're seeing mortgage payments rise significantly faster than incomes, and you'd have to think that logically there has to be a breaking point, right? Well, I guess only time will tell, but this is where understanding what's going on with mortgage rates is very important, because there's a couple factors that are influencing mortgage rates. Obviously, the Federal Reserve Bank's growth in interest rates has put an impact on mortgage rates, because we have seen some of the fastest growth in the Federal Reserve Bank's interest rates in the last number of decades. But in addition to that, we're also seeing Treasury yields rise to their highest levels in 16 years. I've been talking about this more and more in the last couple of weeks, but we have seen the 10-year Treasury yield and the 2-year Treasury yield break record highs. I mean, the highest levels we have seen since before the 2008 crash. Why is that significant? Well, let's back up a little bit. What is a Treasury yield? A Treasury yield is money that you lend to the government. It's considered a risk-free investment. And so if the government can give you a guaranteed return, your job now as an investor is to decide, where do I want to put my money? Do I want to put my money into the stock market? Do I want to lend my money into the mortgage market? Or do I want to give my money to the government? If you can get a guaranteed return from the government at, let's just say, 5%, well, that's risk-free. If you were to compare that return versus giving somebody a loan, a mortgage, you would need a higher return, because that's more risk. I mean, there's a better chance of you defaulting than the government defaulting, in theory, right? And so now, as Treasury yields are rising, that's naturally pushing up mortgage yields. But the question is, why are Treasury yields rising? And there's a couple different factors to this. The short-term Treasury yields generally rise due to what the Federal Reserve Bank is doing. We've seen the Federal Reserve Bank raise interest rates many times in the last 18 or so months, and that has pushed up short-term Treasury yields. However, more of the longer-term Treasury yields, like the 10-year Treasury yield, have risen not just because of the Federal Reserve Bank, but because of investors' worries of inflation, and because of investors' worries about a potential recession, and because of investors' worries about the government or national debt in our economy. And so because investors are worried about lending their money to the government, you've been seeing that these yields are rising because the government needs to incentivize you to keep lending money to the government. And how do they incentivize you? With a higher interest rate. This is where understanding this financial education is so important, because now your job as an investor is to understand how the whole economic system works, that way you know the best places to invest your money. Now we're gonna jump back into the housing market in a second, but if you are an investor and you wanna learn more about how to invest your money smartly, we have this free ebook on how to build wealth as an investor that you can read. My Briefs media team put this together. It's completely free. It'll walk you through the basics of, well, how do you save the first couple $1,000s? How do you build your mindset of an investor? To how do you invest your money for cash flow? And what are the different ways that you can invest your money? This ebook is completely free. And if you want to read this ebook, I got the link to how you can download it down in the description below. Now, going back to the housing market. Treasury yields have been rising. That is good news if you are an investor that's lending money to the government, because now it means you can get a better return. But that has implications. One of those implications is in the housing market. Because now if the government is offering higher yields, that means a bank is going to have to charge you higher interest rates as well. Because if the bank can get a guaranteed return by lending the money to the government, and that guaranteed return from the government is higher, they're going to have to charge you a premium because you are riskier than the government. So higher treasury yields also push up mortgage rates. Well, we're seeing two things happen. Inflation is still high. And if inflation is still high, that puts more pressure on the Federal Reserve Bank to keep raising interest rates. That's higher pressure on mortgage rates. And then second, you're seeing more and more worries about inflation, more worries about the United States debt, more worries about the United States economy. That pushes higher pressure on treasury yields. Higher treasury yields also push up mortgage rates. So now you're seeing two things happen. Federal Reserve Bank interest rates, Federal Reserve funds rates higher, treasury yields higher. Both of these things are pushing mortgage rates higher. Both of these things make home affordability less affordable, lower home affordability. That means now it is more expensive for you to buy a home, even if home prices don't rise. Now, what we're seeing is that home sales are falling. Why? Because buyers are looking at homes and you think, okay, maybe I'll be able to get a 6.5% mortgage. Then you get closer to the closing table because it takes you so long to find the right home because there are not that many homes available for sale. So now you end up looking for a few months to find a home. You find a home that you like, you talk to your banker, and he or she says, oh, you're not gonna be able to get a 6.5% mortgage now. You're gonna have to pay 7.75%. Now you thought you could borrow $450,000 comfortably. You found a home that fits within your budget, but now mortgage rates have risen so fast that the home that you thought was in your budget is no longer in your budget. And now you have to decide, do you wanna stretch yourself further or do you wanna wait it out? And you're seeing more and more buyers wait it out. Well, generally, that would cause a slowdown in home prices, but there's also such a low inventory of homes as of now that sellers are saying, well, we don't really care that much, or we don't even have to sell, because sellers are saying we don't want to sell our homes because if we sold our home today, we're gonna have to go from our 3.5% mortgage that we have currently to a new 7 or 8% mortgage, which we don't want to pay. So you can see that we still have this low inventory of homes, and buyers are also getting confused as to whether they want to continue staying in the market. That's creating the slowdown in sales, and if it continues like this, you'd have to imagine that eventually sellers are going to say, all right, we need to sell our home, we're willing to cut the price. And if that happens, if home prices begin to fall, then you could see people start to lose their equity in their homes, which could create kind of a different domino effect of issues, but we haven't reached there yet, because home prices have gone up so significantly. Now you're not seeing that same growth in home prices that we saw last year, but we are seeing a rapid growth in mortgage rates. And so now the question is, what's gonna break? Is it going to be that mortgage rates will fall? Will it be that home prices will fall? Or will it be that people's incomes will rise? Now, in order for people's incomes to rise fast enough to keep up with the higher cost of homes, people's incomes will need to double. And that's not gonna happen, it's just not practical. So the question is, will mortgage rates fall or will home prices fall? And for mortgage rates to fall, according to the information that we're told by the Federal Reserve Bank, we would need inflation to fall significantly and for it to stay lower. But we're not seeing that happen. In fact, we've been seeing inflation stay high. Inflation hasn't reached the Federal Reserve Bank's target rate of 2%, let alone stay low. We've been seeing inflation rise over the last few months. So if inflation isn't where the Federal Reserve Bank wants it to be, and it's still not going steadily down, that's more pressure for the Fed to at least keep interest rates high. maybe even raise them higher. And then you have home prices. Well, sellers don't want to sell, and builders are building very cautiously. And this is where understanding the housing market moves much slower than the stock market. But your job now as a financially educated person is to understand the different dynamics of the housing market. That way you can make a smarter decision. Now, if you're a home buyer, what does this mean? Well, the most important thing is buying a home that you can afford. If mortgage rates fall, you can always refinance and get a lower mortgage payment. If home prices fall, well, as long as you have a fixed rate mortgage, that doesn't necessarily affect you. Maybe you lose some equity in the home, but your goal is to make sure you can comfortably afford the payments. If home prices go higher, well, that would benefit you if you go out and buy a home. This is where you don't necessarily want to try to time the market, but rather understand the market. That way you can make a better decision for you, because for me, I'm just going to give you my opinion here. Buying a home is buying a liability. If you want to buy a liability, there's nothing wrong with that. It's great. Just make sure you can afford it. Don't go and stretch yourself too thin to buy a home, because every realtor and mortgage banker will tell you that this is the biggest investment of your life. It is not a true investment. It is a liability. Can it make you money? Absolutely. But is it guaranteed to make you money? No. Are you buying it to make money? No. You're buying it to make memories. So treat your home like a liability, and if you do that, that will prevent you from stretching yourself too thin when you go out and buy a home. So essentially just be a smart home buyer and don't try to jump into anything, and don't try to perfectly time the market. Buy what you can afford if you find something that you can like, and then don't worry about anything else. I guess that kind of covers the housing market.